Hey traders, welcome to Charts and Coffee. We are taking a look at a Tantrum Monday, but let's go a little upstream before we just presume this is the beginning of the end and that we are all surprised by the weakness. We know that the 4-year cycle means we've got a lot of different realities to adjust to, probably none more so dramatic than what we've seen in this presidential cycle, the 4-year cycle. The beginning of the year tends to be a time where sector rotation can dominate. Sectors that were lagging in the previous year have the ability to sort of outperform sectors that were leading, sectors that were strong in the beginning, at the end of last year. And we can definitely see that sectors like healthcare benefited from that. But in the big picture right now, and every weekend is going to be something where, going forward, it's interesting. For the most part, stops are typically organically hit when you're using a plan. What's not a plan? Max debit is not a plan. Never has been, never will be. But if you have a stop loss based on the validity of the trade or an allowable amount of risk to your account, not allowing a full debit loss, then you're probably realizing, as most of us are, as certainly we are in the Sector Secrets Mastery, that stops are going to be hit in a fairly natural way, where we have a trade idea, we've position sized in a way that we can manage risk, and yet we're optimistic for the follow through or the continuation of the move in our favor. And very slowly through January, what was a book of 4 or 5 trades has now whittled down to 2. We have 2 positions open right now. And the one that I'll be watching most closely will be GLD. GLD is probably it is our most recent position. It continues to be our position where, of all the things that I'm looking at right now, it has a trend. So if you haven't looked at gold, if this is not something that has been on your regular watch list, please, please, please do take a look at gold, and even maybe gold miners in terms of benefiting from the strength in gold. Tariff tantrums are going to continue. They're not going to be easy to deal with. We all know this. But let's do something else. You'll notice there on the notes there on the left, I talked about gaps, support, and resistance. And if we take a look at the S&P, for example, let's be really, really on point with where we are in terms of the behavior of the S&P. Is this an uptrend? Not even close. This is not an uptrend right now. It's not been an uptrend since, and let's get really specific, the 19th of December. So we're well over a month at this point of having lost the trend. Now remember that the 19th was the day after Powell basically lowered the boom on expectations of ongoing cuts. In fact, we really see now that in September, he said it himself, got to give him credit, that he's getting out ahead of the curve with the 50 basis point cut. So rather than a full 1% or 100 basis points doled out in quarter point increments, he gave the first one at a half point and then 2 more at a quarter point, and we ended 2024 with 1 full percentage point lower a Fed funds rate. Now, are we still expecting rate cuts? Absolutely. And that's because the Fed fund futures continue to show that at least 1, if not 2, rate cuts are absolutely still in the cards. 1 for sure, 2 probably, and 3 possibly. Possibly to say it's not impossible, but it's probably improbable, right? So if we take a look at the Fed fund futures, whose sole job it is to measure what the Federal Reserve is doing and have a contract associated with each meeting, understanding what monetary policy shifts might be made, that's what right now is in that. And by the way, what makes that so, I'm not going to say infallible, but pretty darn close? Because the Fed fund futures are something that the Federal Reserve watches too. And that's their sort of gauge, if you will. That's their barometer to our expectations. And if they're not willing to shift those, if they see that, broadly, expectations are that we're going to see that we're going to give the markets a quarter point cut or 2 quarter point cuts, they have a choice. They can either give us that thing, or they can walk us down from that expectation. So them not walking us down, for example, when Powell had the meeting at the end of January, he didn't walk us down. In fact, if anything, might have walked us up on a second rate cut expectation. So this is what I mean, right? They know what we're expecting and they can adjust their languaging accordingly. And if they don't, they're okay with what we're expecting based on what they know. And that's the dance, right? That's that barometric pressure between these two forces, what we're expecting and what they plan on doing. All right. Now the S&P has been in chop, and in chop, some days the bulls are going to feel like geniuses and some days the bears are going to feel like geniuses. And frankly, you can look at it this way. Either nobody's right or they're both right. It just depends on the day. Now, having moved lower into the range, we're now in that lower, nearly, I would consider this on the way to being more oversold. Does that mean I'm going to simply buy? No, there's two ways we can tackle the environment right now. One is we can shorten the trend. So in chops versus trends, what are the things that I can do? I can shorten my time frame. Right? These are things that are adjustments we make in times of uncertainty. Again, chop is uncertainty, right? And if chop is uncertainty, meaning a wide range, those of you that have been following me for any amount of time, whether that be at the Sector Secrets Mastery Room or here at Simpler Trading or here in Charts and Coffee, I'm a huge I was hugely influenced as a very young trader. I'm talking in my teens by Charles Dow's work. And if there's two people that have influenced my work the most, it's Charles Dow and Richard Schaubacher. And I look at all the trading information that's come since those two gentlemen did the bulk of their work in the early 1900s, in some cases, over 120 years ago with Dow and over 100 years ago with Schaubacher. So when we're looking at what they're saying, almost everything is rooted in their work. If you want to know where most trading ideas, most analysis come from, it's Dow and Schaubacher, right? So why not study the source? And you'll see with Dow talked about the way in which markets behave. There's four psychologies, call them four phases, call them four trends, call them four stages. I don't care what the word is, but there's four behaviors, right? We have uptrends, Dow called them markup. We have downtrends, Dow called them markdowns. We have sideways ranges like what we saw here through the early part of December. Even though it was bullish, it's a narrower range. Some people might call them narrow channels. Some people might call them accumulation. That was Dow's language. And then there's distribution, wider choppy ranges. And we just cycle between them. Not in a particular order necessarily, right? Accumulation can turn into distribution. Distribution can organize into eventually an up or down trend. We just need to know one of these four behaviors is always present. As long as we know what we're looking for, we can then start to decide what tools, what rules, what setups are valid for the environment we're in right now. Gang, if you just understand what I said in those last, 45 seconds, 60 seconds, that is the game of trading. What is the environment we're dealing with? And therefore, what tools, what rules, what setups do I bring to the game? Right now, this is chop. I go look at my choppy market tools. It could be understanding where my Darvis support and resistance are. It could be understanding where my overbought, oversold oscillator is, right? I have two things I love using, a slow stochastic and or my secret squiggle, which is really a modification, frankly, a slight improvement, if I may say so myself, on what I got out of a 21K 3D slow stochastic. If you don't have the secret squiggle, don't worry, put a slow stochastic. 21K 3D, 80 overbought, 20 oversold. Listen to me now, believe me later. It's going to be a great way to understand what's happening. We wait for those overbought and oversold signals. We wait for price to sink into the lower half, the lower quarter, and as close to current support zones as possible. And we remember that we go back and forth in a range until we don't. It's not our job to predict. Never have I seen in the last handful of years more traders fixated on predicting what's going to happen rather than what the job of trading really is, which is we respond. We're counterpunchers, right? We're not bigger than the market. We respond to the market. The market is enormous. We're basically nimble, like a gymnast or a ninja. Pick your athlete. That's the way we look at the way we respond to what's happening. So when I see a gap down like this, I'm going to think, okay, what open positions could be subjected to this? I do have a long position at a break-even stop in Jets. The gap might undo some of that, and I might have to cut that loose. We've already scaled out once, and then the next measure would be protect my capital. All right, we have the long position in gold, which is at this point just a heck of a trade, and it's probably the best trade I've got coming out of January. And I still have plenty of time to expiration, so we'll see how much longer that continues to move. Some of the emails that I got over the weekend, and I will say, being early to a trade, by the way, gang, is the same as being wrong. Being early to a trade is the same as being wrong. I know we use early as a euphemism. It's the same thing as wrong. I was probably early or mistimed a lot of what I was looking for in crude, because in my thought process, the trend and the underlying narrative of tensions and tariffs would ultimately create movement higher in crude, right? So notice crude's not gapping down today. In fact, it's moving higher. Anything that starts to mess with, right, starts to take away from the supply, anything that starts to interfere with that tends to be bullish, right? It's not a demand narrative. It's definitely a kind of a disruption of supply type narrative. And you can see while we're getting significant gap downs on the broader averages, crude's actually got a mild gap up. So this is where I like the narrative. I liked the trend. It just took the scenic route. But this is back to being something I might take a look at going forward. But it would be purely a crude oil play, not the oil stock plays. That's something to keep in mind. I mentioned gold very much. I do like the idea of continuing to be bullish in gold. Copper might be another thing. Gang, if we're talking about tariffs and we're talking about commodities and the supply being disrupted, that could be bullish. It's not the best kind of bullish scenario. Higher demand is always the best foundation. Having economic expansion being the reason, the catalyst for the move higher is always going to be the best bedrock for commodities. But sometimes disruption of supply or concern of a disruption for supply is going to create a similar type, but more volatile, more chaotic type bull market. And you can see natural gas actually gapping up, right? So you can see some of this is already making its way into the broader commodities. What about copper, right? Look at copper's up too. Copper's up, gold's up, natural gas is up, crude oil's up. So if you don't know how to trade commodities, this might be a really interesting space right now to learn more about. We do that quite often in the Sector Secrets Mastery. I've been an avid commodities trader for longer than I've even been an options trader. It's my first love, and it's the grocery store to the world. And it's a very, it's an interesting place to be cued into right now. All right, moving on. By the way, if you're thinking, Rog, this is all kind of interesting. I'd like to learn more about this. How are you managing an environment like this? Check out the webinar's coming up day after tomorrow. So if you haven't already, at this point, penned it in Wednesday, February 5, 8 p.m. Eastern. I'm going to talk to you all about what it takes to be consistently profitable. And I realize it's really interesting what it is that traders are cued in on. If someone talks about, hey, made a lot of money on a singular trade, it's really interesting where traders' attention is going to be diverted there. It's actually a sad commentary on where trading education and trader mindset is right now, because the fact of the matter is we're going to have to withstand a lot of volatility in this environment, and a lot of traders are not going to be equipped with the tools and the guidelines to do so. Those of you that have been trading for 10, 15, 20, 30 years, like me, are going to realize that everything has its time. There's going to be a time for chop. There's going to be a time for weakness. There's going to be a time for strength. If we don't have a way to recognize which phase, which behavior we're in, we're really going to struggle. If we don't know how to recognize which behavior to avoid, we're going to struggle, right? And if we always trade in fear, right, we're not going to be able to make good profits like 2024 presented us again and again and again. So ultimately, what we want to do is have a plan for every type of market behavior, right? So consistency, and it's funny, I did a whole video on consistency on Friday, and it's always fascinating to me what broadly folks click on. Oh, okay, consistency. Not many. Very interesting. That's something that traders have got to learn Folks can talk about how much money they made, and that's cute and that's great. I like doing that too. But the bottom line is, what are the processes that we do again and again that set us up for those profits? Not discussing about a one-off trade, right? But what are the processes that allow us to find those more regularly? And at the end of the day, the ongoing chop, and take a look at the NASDAQ, same scenario as what we had in the Dow. Same scenario as what we have in the S&P. We're in chop, gang. We're in chop. We haven't been in anything but chop since, in some cases, middle or beginning of December. So chop is not new. The volatility is obviously pushing things lower. But notice something else. Before the volatility kicked in, this is what process is. This is what consistency is. Before the chop kicked in, and the same thing goes with the sell-off in NVIDIA. It's amazing how often the news tends to correspond with, don't be long at the top of a range. Before NVIDIA gapped down, where was it? It was really in the overbought part of the range. It wasn't in a trend. It was actually near highs. I don't want to buy at highs. That leaves my trade very, very vulnerable to overbought shorts or overbought sell-offs or profit taking. Same thing goes to the S&P. The S&P just flirted with the upper end of the Darvas zone on the 23rd. This is not new. This weakness, this area from which I would question whether there's more traction to the upside, it's an overbought zone that triggered back on the 23rd and 24th. You see here. I'm not saying we're trying to go back in time and say, oh, that was leading to this. No. What it leads to is, why on earth be long from this area around 6150 in chop? That's not the shot that we want to take. That's not the environment of, hey, we can buy higher highs and it'll continue. That's not the environment we're in. Uptrends are that environment. Or off support that's oversold would be that environment. But in a choppy market, buying up towards the highs, that's just really that's cruising for a bruising. And a lot of folks are finding that out the hard way. We don't always expect breakouts. By the way, who does? Your average retail trader. They've never met a higher high that they can't resist buying into. And sadly, they're the ones getting hurt pretty badly right now too. So those are things to keep in mind. We have a lot of volatility coming in based on news, but look at the price action. We've had a lot of volatility in chop since, frankly, mid-December. So this is not new. It's just ratcheting up two things, the rhetoric and the volatility, right? Okay. So a couple other things to keep in mind. Just as I talked about commodities being an interesting part of the bigger picture markets to keep an eye on, there's two other things that we've been talking about in the mastery that I would highly recommend. Yes, shortening time frames, right? And then where am I looking? Where am I looking for clarity for setups, right? And so I'll put this in the notes here too. I'm looking for clarity in setups, as we already mentioned. Let's take a look at commodities. Let's take a look at that grocery store to the world, right? And then let's also keep an eye on currencies, because it's not just the U.S. central bank, the Federal Reserve, that's shifting monetary policy. You'll see monetary policy messaging is shifting out of Bank of Canada, out of the European Central Bank, out of the Bank of England. So those G7 countries are going to be starting to shift monetary policy, and they all do for the most part, with the exception of the RBA and the RBNZ, the Reserve Bank of Australia and the Reserve Bank of New Zealand. They all tend to move in waves that are pretty similar, not exact, but pretty similar. And if we're seeing those shifts, currencies are going to be on the move as well. So those are some cool things to keep in mind. It doesn't have to be, how am I going to trade the S&P today? It doesn't have to be, how am I going to trade semiconductors and NVIDIA today? That doesn't have to be that narrative at all, right? We look at where the current attention, even news, where is that? And then we look to see if there are setups and clarity in those places. Really interesting. If you take a look at the Euro's been in a chop for a long time too, and mostly bearish chop. Look at this, up near highs, and then it's moving lower. So this actually means the US dollar is strengthening right now for two reasons. One, we don't expect as many more cuts from the Federal Reserve. Cuts are weakening catalysts. Cuts tend to weaken the currency of the country, while hikes or anticipation of eventual hikes tend to strengthen it. There's a lot of factors that move in and out of what moves a currency, but these would be another, whether it's foreign exchange, whether it's futures currencies, this would be another area to start maybe sharpening your saw for. And if you haven't got a plan for these, come check out what we're doing on Wednesday. Come check out what we're doing in the Sector Secrets Mastery, and I'll see you all tomorrow. Same time, same station. Webinar is Wednesday. You probably all got emails already. You can register at simplertrading.com/consistency. All right, gang, be good to each other. I'll talk with you soon.